Greetings, I'm Andrew Ludwig, and welcome to BLACK ONYX, Alternative Investments, where we bring you face-to-face with South Africa's most talented boutique asset managers and industry stakeholders. Why do we do this? Because we believe you, the investor, deserve to be better informed in order to achieve the best risk-adjusted returns. We are speaking to Jacques Conradie, who's the co-portfolio manager of the Peregrine Capital High Growth H4 Qualified Investor Hedge Fund, a long-short strategy that was established in 2000. Jacques, thank you for joining us. Could you give us a bit of detail on your background and how you got into the alternatives?
I've actually got quite a quantitative background. I mean, while at school and university, I represented South Africa at both the International Mathematical Olympiad and the International Computer Programming Olympiad. I then went on to study actuarial science at Stellenbosch University. My first job was at Old Mutual, and I spent about 18 months there working as an actuary while I qualified and finished my exams. But during that time, I started doing the CFA exams, and I actually realized that I had a lot more passion for the content of the CFA exams, and I could really see myself working in investments for the majority of my career. So at that point in time, I made the decision to leave Old Mutual. I guess found the investment work a lot more stimulating than the actuarial side. I looked around, and I think one of the things I was looking for was quite a small dynamic team. I think working at a big company taught me that I think the impact that any individual can have on a company with 30 or 40,000 people is very limited. Where in a smaller company, you can really see the impact you have on the bottom line of the results of the company. So I was lucky enough at that time to find an opportunity as an investment analyst at Peregrine Capital, which was already then the longest running and most successful hedge funds in South Africa, and I joined the business in 2007.
Tell us about Peregrine Capital, its genesis, and some of the strategies that you represent.
Clive Nates and David Fraser founded the business in 1998 after they left Liberty Asset Management, which was at the time one of the largest long-only institutions in South Africa. One of the founding principles of the company, and one of the reasons why they left Liberty to start Peregrine Capital, was they found that in Liberty, or in most of the long-only asset managers, as you progressed and became more senior and a fund manager, you actually end up spending more time with your clients rather than with the actual companies you cover. And all of us in Peregrine Capital are very passionate about researching companies, spending time with management teams. So that I think I was quite lucky to join a business where that was one of the founding principles, that we would always try to spend as much time as possible with the companies we cover. And they also set up the business to run with, at all times, generally 3 or 4 different fund managers. And what this allows us to do is to split the market up between the fund managers so that each of us can still stay very close to the companies we cover. And our end goal really is to make sure that the shares we're invested in, we want to understand them as well and hopefully better than anyone else in the SA market. And I think that's where the edge comes from. On the strategies we manage, we've got 3 broad strategies. We've got a pure hedge fund and a high growth fund, and then a medium risk fund in between. But the core way we run the funds is that any good idea goes across all the mandates, and we simply tailor the risk profile to the type of investors and the strategies. So the pure hedge fund, for example, is a lower risk strategy. It's actually never had a down year in the 20 years that it's been existed, where the high growth fund is potentially higher return, higher vol strategy, where we take bigger bets in the companies we really like. So you'd expect higher returns there, but at the cost of somewhat higher volatility.